In this video, traders, we're going to look at the simple 210 period moving average trade you can use for swing, intraday, or long term. Stay tuned. Hey traders, a very warm welcome to you. So this is an interesting trade setup, right? One for you day traders, one for you swing traders, and one for you position traders over the longer term. Very, very simple to trade, and I quite like this because there's an extra little sneakiness to it that gives it its edge. Okay, so I have got two simple moving averages on your screen now. One is a 200 period. The second one in red here is a 10 period. I've also got on the bottom of the chart here an average true range. The settings on that are the standard 14. I've changed the style to a histogram, which is just personal preference. So the idea of this trade is once price has crossed above or below a 200 moving average, you then wait for price to retrace back to the quicker 10 period moving average, the one in red. Then once it's retraced back to it or under it, you wait for a close back above it in the case of a long, back below it in the case of a short, and you take the trade. Targets 1 ATR. Let's have a look at an example. Okay, so gold, for example, right here. You would have a short setup as the price goes below the 200p moving average. Price comes up and it touches just above, but you don't get a close below on the next day. It's still there, it's still above the moving average. So you've got no signal. Even if you do, even if you kind of look at that and you ended up taking it, the risk is the prior day's candle. So we're talking $4 or $5 stop. However, the next signal, price goes above that 200 period, comes back, pulls back, kisses the 10 period, closes above it the next day, closing at 13.22. This is on gold, by the way, daily chart. You've got a nice big move, and the idea is you take 1 ATR. Average true range on the 14 period from here is 11 something, call it 12. You've got a $12 trade. You get that pretty much by midday by the look of it. Stops on that are under the previous candle unless it's bigger than your ATR target, in which case you use the ATR. So it's a one-to-one risk reward, which might not appeal to everybody. I get that. Some people are very strict about the risk reward ratio. However, the probability of success is reasonably high, so it should outweigh this kind of thing. Let's have a look at some other charts as well to compare it. So I'm looking here at a 15-minute chart of cable. I think that you can trade this on a 15-minute chart. Any lower, you're pushing your luck. 15-minute for an intraday scalping type trade, daily for your swing trade, multiple days, and then going on a higher time frame, or maybe a weekly, which are going to give you very, very few signals, but for your longer term position trade. So 15-minute chart here of pound US dollar starts to drive low, drives under the 200 period moving average, comes up, tags it, we're all ready to go, and we get a close below down here. Now, what do you do in that scenario? Well, when you have that scenario, do you know what you do? You don't take it because the risk is way too much. You are now so far away from that 10 period moving average that the trade is no longer valid. You really want it to close just under it so that the next day you get that juice. In this case, it didn't happen. You've got to take it, accept it, move on. I wanted to point that one out to you guys because I think that very often people fall into the trap of, well, it's the system, I must trade the system exclusively. Yes, you definitely must, but you must have rules in for when you know just in your gut that the odds of success are going to be low. Like, for example, it's moved so far away from the 10 period moving average. You know, and I know if you're watching price for any amount of time, price extends away from a moving average, but then will retrace to it, or moving averages will catch up. Yes, you do get runaway trends from time to time, but the most of the price action in markets is an oscillatory action. It's back and forth, it's to and fro. You don't get that clean break all the time. So just being careful of those kind of stuff. Another one for you guys. We push down below the 200 period moving average here with the US dollar JPY, pulls back to the 10 period, tags it. First close below it is here, so it's about 121.20, and then you've got 1 ATR, and I haven't got my ATR up, so let's stick it up. And by the way, just to go through its insert indicator if you're using TradingView, average true range, and I'd always like to change my style to a histogram. I know, because I feel like I can see stuff better on it, but again, personal preference. It's not going to make you a professional trader just because you change it to a histogram. Unfortunately, otherwise I'd have all my stuff on histogram and would make as many mistakes as I wanted, knowing that I had the holy grail of setups. But nevertheless, you push up here, you close at lows here below that moving average, you take your trigger, your ATR is running quite high here actually at 125, so then you're looking for 125 pips on that, and that gives you easily 125 pips. You've got 190, yeah, way more than 125 pips. So you just grab it on the next day, you're out, you're done. Your stop is the same, or like I say, if you want to adjust it, then then okay, I get why you'd want to do that, but the idea is it's a high probability of success, and so if you're getting 60-65% hit rate on it, but you're getting 1-to-1, it's still going to work out. Now, one thing you can do, guys, is that you can try and extend the target. If you feel like you want to go for 3 ATRs, by all means, and stick it in the comment section below your thoughts on that one as well. If you test it out and integrate it with the trading plan, I'm always interested to hear your take on these things. But if you want to extend it to 3 ATRs under the right conditions, yeah, I think that's a great idea. But strictly speaking, those are the rules of the strategy. When the price crosses below the 200, you're pulling back to the 10, waiting for a close back below the 10, going short. Other way around, when price crosses above the 200, pulling back to the 10. Once it tags that and closes back above it, you're going long. All right, guys, take care. See you next one. Bye bye.